Did you know that McKinney, Texas, has just approved a $1.3 billion mixed-use development project? This ambitious plan is set to reshape the landscape of the city with a focus on multifamily units and a blend of commercial offerings. Welcome to the Commercial Real Estate Insights Podcast. I'm your host, Steve Hamoen. Let's get right to it. In a significant move for the North Texas suburb, McKinney city officials have given the green light to a massive development spearheaded by Creation, in partnership with Horizon Capital Holdings and Arizona-based investment company Valter. This 155-acre project, located at the northwest corner of US 75 and the future US 380 bypass, is set to feature a dynamic mix of multifamily, office, retail, grocery, and hotel spaces. The development includes a 318,000 square foot office campus, a 100-room hotel, and 135,000 square feet of retail space, anchored by a 65,000 square foot grocery store. Notably, it will also introduce 1,600 multifamily units and a 5-story parking garage, marking a substantial addition to the city's residential offerings. This development is divided into 4 distinct tracts. Tract 1, covering 10.7 acres, will include approximately 300 traditional multifamily units. Tract 2, spanning 18 acres, will offer about 180 brownstone multifamily units designed to resemble townhomes but available for rent. Tract 3, with 14.6 acres, will feature urban multifamily and commercial uses, including the grocery store anchor. Finally, Tract 4, the largest at 28.3 acres, will combine urban multifamily and commercial uses, complete with the hotel and office components. The approval of this project marks a shift in McKinney's approach, embracing multifamily developments in areas previously zoned for commercial use only. This decision, passed with a 6-to-1 vote, reflects a growing recognition of the need for residential density to support commercial success. Gerry Feltus, the city's mayor pro tem, emphasized the importance of residential density in ensuring the financial viability of retail spaces, drawing comparisons to successful developments west of the city. While there was some opposition, notably from Councilmember Charlie Phillips, who voted no, the project has already attracted substantial interest from potential grocery tenants. According to Thomas Mann from Winstead PC, who represented the applicant, the development's integrated mixed-use setting is highly appealing to businesses looking to attract and retain talent. This multifamily movement aligns with broader regional trends. Research from MMG indicates that the Dallas-Fort Worth apartment market experienced positive net absorption of 7,350 units in the first quarter of 2025, the strongest first quarter since early 2021. The Frisco/Prosper, Allen/McKinney, and Denton submarkets in particular have seen a significant concentration of renter activity, accounting for 1/3 of the area's total renter demand over the past year. For McKinney, the strategic location at the intersection of 2 major highways, US 75 and US 380, presents a unique opportunity. As McKinney City Councilman Patrick Cloutier noted, the area is not suitable for single-family homes, making multifamily developments a logical choice to support commercial growth in this high-traffic corridor. In the ever-evolving landscape of retail, hybrid retail spaces are emerging as a transformative force. These spaces are redefining the shopping experience by integrating multifaceted environments that go beyond traditional retail offerings. In India, this trend is particularly evident as retail spaces transition from conventional malls and high streets to lifestyle-led destinations. As reported by Abhinav Ranjan, hybrid retail represents the cutting edge of modern consumer engagement. These spaces are designed to blend shopping, dining, entertainment, and leisure, catering to the aspirations of younger demographics who seek curated, multidimensional experiences. The Cushman and Wakefield report highlights that Delhi NCR experienced a significant uptick in retail leasing volumes, with Main Street leasing leading the charge. For developers, the focus has shifted from merely leasing spaces to creating multifunctional environments. Jatin Goel, executive director of Omax Group, notes that thoughtful design and purposeful planning are crucial in crafting experiences that inspire and engage consumers. This approach is evident in places like Faridabad, which is attracting investments due to its growing infrastructure and connectivity. Hybrid malls, as described by Pankaj Jain of SPJ Group, integrate culture, commerce, lifestyle, and recreation into a cohesive experience. Consumers today are not just looking for places to shop, but destinations where they can create memories. This shift is driving developers to design spaces with contemporary architecture and world-class amenities, particularly in areas like Old Gurgaon. The rise of hybrid retail spaces is further fueled by evolving consumer expectations, urban growth, and cultural shifts. Arjun Gehlot from Ambience Malls points out that Generation Z and millennial shoppers value destinations that offer convenience and memorable experiences. The integration of co-working hubs within retail zones is transforming malls into multifunctional spaces, catering to the work-from-anywhere culture. Neighborhood malls are also gaining popularity as community hubs offering essentials, wellness, and leisure under one roof. Uddhav Poddar of Bhumika Group emphasizes the importance of designing community-centric spaces that encourage social interaction and repeated visits. The future of retail lies in creating hyper-local environments that blend shopping, leisure, and lifestyle. After a period of uncertainty, the commercial property market is showing renewed signs of confidence as we enter 2025. Despite recent unpredictability surrounding trade tariffs, investors are becoming more decisive, and sentiment is shifting positively. Transactions are beginning to reflect a broader appetite for opportunity, indicating a more optimistic outlook for the sector. Auctions have been at the forefront of this recovery in the commercial real estate market. They often lead the charge in sentiment shifts due to their ability to offer real-time insights into market dynamics. As Nicholson Boyd from Savills notes, auctions are ahead of the curve when it comes to recovery, providing a pulse on investor confidence and market trends. In Kitchener-Waterloo, London, and Cambridge, Ontario, we're observing similar trends. The commercial property market in these regions is experiencing a resurgence in confidence as well. Local investors are showing a greater willingness to engage in transactions, driven by the stability and growth potential in these areas. Across the border in the United States, the commercial property market is similarly buoyant. Auctions in key markets are leading to increased investor activity, reflecting a broader positive sentiment. This cross-border perspective highlights the interconnected nature of the commercial real estate markets in North America. Overall, the growing confidence in the commercial property market is a positive sign for the industry. As auctions continue to lead the charge, they provide valuable insights into market sentiment and investor behavior, helping shape the future of real estate investments. Nick Villa, an economist at Moody's Analytics, provides some insights into the current retail landscape. Retail sales increased at a healthy pace of 3% for the year 2024, before experiencing a 0.9% decline month over month in January, which was short of expectations. However, this decline was mainly due to a drop in motor vehicle sales, which contributed significantly to the overall decrease. Despite this, January 2024 had a similar monthly decline, yet ended the year positively. On the inflation front, the Consumer Price Index in January came in hotter than expected at 0.5% month over month and was higher by 3% year over year. Despite inflation remaining above the Federal Reserve's 2% target, wage growth has outpaced inflation since March 2023, suggesting rising real incomes. Aggregate spending measures have been robust, considering that people in the bottom half of the income distribution account for only 29% of total consumer spending. Moody's baseline forecast for the retail real estate market predicts nationwide effective rent growth to increase by approximately 2% in both 2025 and 2026. The vacancy rate is expected to remain in the low 10% area over this period. Net absorption is projected to outpace completions over the next 2 years, with the gap widening significantly in 2026. The southwestern and southern Atlantic regions are expected to outperform the national average in effective rent growth, while the Midwestern and Northeastern regions may lag slightly behind. The Western region is anticipated to perform in line with the national trend. Several risks to this forecast are present, particularly trade policy and its effects on energy prices. However, interest rates are expected to move lower in the second half of the year, which should bolster spending patterns, especially for big-ticket items such as automobiles and appliances. Moody's assumes the next interest rate cut will occur in the third quarter of 2025. Consumer balance sheets, when analyzed through household debt service as a percentage of disposable income, remain below their long-term average, implying additional headroom despite rising debt balances. Interestingly, despite a full percentage point reduction to the federal funds rate in 2024, the 10-year Treasury yield has remained fairly steady near the mid-4% level. This is partly due to fiscal sustainability concerns and the increasing federal deficit, which would require greater bond issuance from the U.S. Treasury. While economic forecasting always carries uncertainty, the resilience of the American consumer should not be underestimated. In a noteworthy development in the commercial real estate sector, Broadstone Net Lease, Inc. has partnered with Prologis, Inc. to embark on a $78.2 million build-to-suit project. This collaboration signifies a major milestone for Broadstone as they expand their pipeline of committed developments and establish a new relationship with Prologis, a leader in global supply chain logistics. Prologis is renowned for its focus on high-barrier, high-growth markets and its successful track record in developing prime industrial properties. This aligns seamlessly with Broadstone's industrial-focused investment strategy, which emphasizes excellence and long-term value creation. John Moran, Broadstone's chief executive officer, expressed excitement about this new venture and the potential for future opportunities with Prologis. The development, which is set to include a state-of-the-art distribution warehouse for FCA US, LLC, the American subsidiary of Stellantis, is expected to be completed by the third quarter of 2026. This project underscores the growing demand for industrial spaces tailored to specific tenant needs, highlighting the importance of strategic partnerships in the commercial real estate landscape. On a broader scale, this partnership exemplifies the dynamic nature of the industrial real estate market, where collaboration between major players can lead to significant developments. As Broadstone continues to secure land and start construction on additional projects, the focus remains on delivering high-quality spaces that meet the evolving demands of the market. In the context of Kitchener-Waterloo, London, and Cambridge, Ontario, the industrial sector is similarly witnessing a surge in development activities. Local developers are increasingly engaging in partnerships to cater to the growing demand for industrial spaces, reflecting a trend that's mirrored across the border in the United States. This cross-border perspective highlights the interconnected nature of the commercial real estate markets in North America. The collaboration between Broadstone and Prologis serves as a prime example of how strategic partnerships can drive growth and innovation in the industry, offering valuable insights into market dynamics and investor confidence. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.